Ever wonder why the US always has such huge and long-lasting trade deficits? I've looked at the current account balances of every country in the world over the last 35 years. In this graph, the top is the surplus and the bottom is the deficit. Let's single out the United States, China, Russia, Japan, and those oil-exporting countries for discussion. Isn't it obvious that the United States below can be said to have raised the flag of the trade deficit alone? One man took it all and became the biggest buyer in the world. Or at best, the biggest buyer in the world. This, in fact, is also something that makes Trump very unhappy. He has repeatedly mentioned the need to reduce Xiaomi's trade deficit. You see, his first order of business was to start a trade war, slapping tariffs on Canada, Mexico, and China, which happen to be the three largest U.S. importers. So the official reason was retaliation. Border security, drugs, immigration, but many people think it may have something to do with America's huge trade deficit. Throughout history, the U.S. trade deficit has been growing steadily since the 1970s, the largest in the world. Why do you think the United States has accumulated such a large trade deficit? And why is the US the only country that can run such a large trade deficit? Is a trade deficit really bad? These questions may not be as simple as you think, so brace yourself. This episode is interesting to me, but it's also relatively hardcore. If it's too dry for you, I suggest you just grab some water or save it for later. A trade deficit is simply a country's total imports greater than its total exports, buying more than it sells. So we analyze the trade deficit is the most intuitive to consider from both sides, or import too much, or export too little. Import too much, it was said, because foreign things are too cheap, like what? East Asia, Southeast Asia. The low cost of labor, combined with the possibility of subsidies and even dumping by these exporting countries, tempts or deliberately attracts U.S. businesses or consumers to import their goods. Too few exports? A lot of people might say, the U.S. manufacturing industry is not competitive enough, costs can't be kept down, can't compete with overseas companies, etc. But if you ask an economist, or even an economics student, what causes the trade deficit, he can tell you, is the economy's inadequate savings rate. How about that? I don't know. Don't be scared, Let's go into this little economics class. Through a very basic series of formula derivations, we can get a very important formula. That is, a country's balance of trade is equal to total savings minus total investment. Let me explain briefly that the definition of saving and investment here may not be the same as the definition of personal saving and investment. The economic definition of total saving is your annual income to spend. Let's say you've earned $100,000 this year, and you've spent $60,000 on consumption. That leaves $40,000. Whether you put money in the bank, invest in personal financial products, or buy stocks, all of that counts as saving. It's not that just because you buy money, it's called investment. It's not called investment, it's called saving. And what does total investment mean? It refers to those investments that can really boost productivity. For example, if you buy a factory, if you build a factory, if you buy equipment, that's an investment. When a country is completely closed, with no trade balance, its total savings is equal to its total investment. And how can it keep up with that? That's why it says it has a trade deficit, because it has an inadequate savings rate. However, I tell you that this causal relationship that sounds strange to you is actually a formula derivation. You can also say that it is actually a nonsense, which is equivalent to you asking, why is this water spilling out of the glass? He told you it's because there's too much water in the glass, right? What we want to know is, why is there so much water in this cup? Why is there too much water in the American cup? Why is the US saving rate inadequate? Some people will further explain this problem. Low savings means overspending. So because Americans love to spend too much, they just want to buy things all the time, the United States has been unable to meet such a large demand for buying only from overseas imports, resulting in such a large trade deficit. Doesn't that make a little sense that a Nobel laureate Stiglitz thinks that Trump wants to reverse the US trade deficit? Then you gotta encourage people to spend less and save more. Once they do that, the trade deficit will go down. No need for all that extra repetition. Just keep it simple and straightforward, and watch the numbers start to shift in the right direction. Another explanation is that, in America, you have too big a government deficit, too big a spender, too low a savings rate. It's the government's problem, not the people's. So the US government, you have to reduce the deficit, you spend less, you borrow less, and the trade deficit comes down. And what is even more amazing about this foreign exchange is that it is not only a converter between the currencies of different countries, it is also a very sensitive automatic adjustment device. What does that mean? That is, if you have persistent trade imbalances, the exchange rate will move up or down to adjust your trade level. Let me give you an example. For example, when the milk tea country runs a trade deficit, you have to pay for the US dollars if it continues to import, so it will continue to buy US dollars and sell milk coins. And then the milk coins will have depreciation pressure. Devaluing will export itself and keep importing, so that gradually it can reach a balanced state. And then the devaluation pressure of milk currency will disappear. So if there is no artificial intervention in the foreign exchange market, the foreign exchange will be like an invisible hand to adjust, so that a country's trade level to maintain a balanced state. Look at the reasons we just explained. For example, in the short term, a U.S. trade deficit may partly stem from American consumer spending and government deficits. But in the long run, supposedly, the market will adjust itself. Let the dollar depreciate, gradually correct the U.S. trade imbalance to the fact that the U.S. has been running a trade deficit for nearly half a century. We need to figure out why the dollar's self-correcting mechanism has stopped working. It simply doesn't function anymore. There must be some underlying reasons. We've got to think carefully about why it fails to kick in when it's supposed to. The logic behind this is definitely worth digging into. This may well be the key to why the US has long-run persistent trade deficits. First of all, a very normal guess is that someone is distorting the automatic adjustment mechanism of foreign exchange by intervening in the market. For example, many developing countries, in order to maintain the stability of trade and the stability of the economy, will be tied to the dollar. Or the central bank may be very active in regulating the exchange rate by suppressing the automatic nature of foreign exchange adjustment through these artificial means. The end result is often an overvalued currency. This, in turn, leads to trade deficits. MF has calculated that by the early 2000s, about a quarter of the world's currencies were overvalued, with official prices more than 10% higher than on the black market. The United States has intervened in foreign exchange before, but in the opposite direction. It wants to weaken the dollar and reduce its trade deficit. You've probably heard of the Plaza Accord. In the 1980s, because of the tight monetary policy and the expansionary fiscal policy at that time, the United States once led to a sharp appreciation of the dollar, which hurt American exports, especially affected by Japan's exports of cars and electronics. At that time, President Reagan took Japan, France, West Germany, and the United Kingdom under his wing and said, "Brother, life here is not easy. You should all quickly adjust and raise the local exchange rate of your country. Let the dollar fall, take care of our exports, and reduce the U.S. trade deficit, And it worked. You see, after 1985, the U.S. trade deficit shrank significantly. This was due to the depreciation of the dollar after the Plaza Accord, but let me stress that this does not mean that Plaza was a very successful intervention. It had a lot of side effects, and we're not going to do that today. But if we look at it purely in terms of exchange rates affecting trade, this is a really good example. Since then, however, the US has rarely intervened directly in currency markets. Yes, it has, and in very small quantities. And you can see that after 1995, the US trade deficit has been getting bigger and bigger. So it's clear that the persistent US trade deficit is not the result of the US government or central bank pushing up the dollar. We're getting to the heart of the problem, bit by bit. In fact, what foreign exchange controls automatically is not only the country's trade balance, but also an overall external capital flow. What does that mean? It doesn't just mean the flow of capital that comes from selling goods and services. It also includes the flow of capital itself. For example, if I send money across the border and invest across the border and I buy stocks, these are all flows of capital itself, even though the US has been running a deficit on the trade side. If we look at the flows of the financial account and the capital account together, right, what a beautiful perfect axis. The symmetrical chart, so this automatic exchange rate adjustment mechanism, it doesn't actually fail. It's just that you've probably only heard half of the story. This chart, this is the essence of the video and the whole story. Let me break it down for you. A country generally has three major external accounts: the current account, the capital account, and the financial account. Current account, capital account, and financial account. Taken together, these three accounts represent a country's overall balance of payment. Below this current account is mostly trade. There may be some investment income, dividends, wages, etc., but mostly trade. So sometimes people mix trade surpluses and deficits with current account surpluses and deficits, and these last two capital and financial accounts, you probably don't hear much about, but they are very important. They include cross-border flows of all financial assets and financial liabilities, such as FDI, which we often hear about, as well as banks, insurance companies, and funds in various countries. He may buy stocks and bonds, including those of central banks, which are held in financial accounts. For most of the world's balance of payments, it is still mainly the current account, the capital flows of trade. But the United States is different. Its capital account and financial account, mainly the financial account, flow very frequently. And these funds are very flexible. So for the United States, relative to the current account, the financial account and the capital account are more dominant than the current account. Don't get confused. So if we look at these three accounts together, there is the picture we just saw. For the United States, its overall balance of payments is almost flat. But between the financial account and the current account, it is one high and one low. It's running a chronic current account deficit. A combination of financial and capital account surpluses means that people invest dollars, and the United States uses those dollars to buy goods abroad. The main reason why the US has been running a persistent trade deficit for half a century is that these persistent capital inflows have allowed the dollar to appreciate, and that has led to the US trade deficit. There is a lot of money coming into the United States from all over the world to buy US Treasury bonds, corporate bonds, stocks, so that US companies and the government have enough capital to invest, to expand, to spend. In that sense, the US has been a big beneficiary, particularly of Wall Street and internet companies, but also of the US government. Many times when you listen to the American media or some politicians, they may only emphasize the commodity sector, saying that we have such a large deficit. They feel as if they have been wronged so much that other people have made all the money. But in fact, the US trade deficit does not mean that money is taken away by others. It is more due to the unbalanced relationship between its current account and its financial capital account. So after you understand this layer, it is easy to analyze that if the United States only imposes trade sanctions on one or two countries or certain categories of goods, it may cut the trade deficit short term. But in the long run, in theory, it might just reshape the structure of US imports. Used to be that you went to Canada, Mexico, China, and now it could be Japan, Australia, the European Union, etc. As long as the demand for its financial and capital accounts continues to flow in, the trade deficit is going to be very hard to reduce. How do you think so much money is flowing through the financial accounts to the United States? Some people may think that the US economy, investment opportunities. You see what the internet giants, financial giants are all in the United States. That's true, but I think the most important reason for that, the most special thing about America, is that it prints dollars. It's the world currency. Let's take a look at the central banks of various countries. How do they accumulate their foreign exchange reserves? For example, the milk tea country, exports a lot of milk tea and earns a lot of money all day, which may be mainly US dollars. Theoretically, he needs to convert these dollars into his own currency in the market. Milk coins can only circulate in milk countries, so these companies have to sell US dollars on the market and then buy cryptocurrency, which will lead to fluctuations in the price of milk coins. Therefore, in order to avoid fluctuations in the price of milk coins in many countries, in fact, what he would do, his central bank would tell these merchants to stop trading in the market. You all come to me, give me the dollar, and I'll give you the milk money. In this way, the central bank actually printed out some milk farms out of thin air, and then accumulated these foreign exchange reserves by itself. That is, how much foreign exchange reserves do the central banks of various countries have? In fact, it shows how much money it has printed out of thin air. Are you wondering why I'm telling you this? Don't worry, the key point I want to say is, do you think this milk tea country, after it has accumulated such a large amount of foreign exchange reserves, what will it do with this money? Is it to buy gold? Generally not. After all, the US dollar is the major currency. We need to see why the dollar's self-correcting mechanism failed. It just doesn't work. There must be reasons, and it's worth digging into. For example, buying US Treasury bonds, MBS, corporate bonds, etc. The typical Japanese, for example, has trillions of dollars in foreign exchange reserves, which it then reinvests in US Treasuries and is the US government's largest foreign creditor. So you see, all this way around, the money that countries make from their trade surpluses goes to their central banks, and most of it ends up in dollars. And this part of the capital flow is about $100 billion annually. And not only the central banks of various countries. For example, insurance companies, banks and funds, in fact, are also similar because the dollar is the world's currency. Since the vast majority of the world's investment commodities are denominated in US dollars, the money you make on the international market may be in Australian dollars, Japanese yen, or euros. But much of it ends up in US dollars, in dollar assets. And so it runs a persistent financial account surplus. An unbalanced balance of current account deficits. And if you look at the United States, the trade deficit's timing backs this theory. You see that its trade deficit started right after the United States left Bretton Woods. The dollar no longer needs to be backed by gold, which underpins petrodollars. And the US can continue to expand its debt and credit aggressively, allowing the international dollar cycle to expand exponentially. This is also why you will see a very interesting phenomenon. That is, the better the US economy is, the larger its trade deficit is. If you think that the US economy is good, it will attract investment, and the current account surplus will be large. Then the dollar will appreciate. The trade deficit is bigger. So from this point of view, the better the development of Silicon Valley Wall Street in the United States. Its manufacturing industry will definitely be held back to some degree. Let me quote the Federal Reserve as a conclusion to the long chain of logic we have today. When the United States can buy goods from world markets simply by printing money or issuing bonds, it is bound to run persistent trade deficits. The current international monetary system, which is based on the US dollar as the main world reserve currency and US government bonds as the most popular means of value storage, is the root cause of the continuous trade deficit of the United States. You see, I am not the only one who has put this nonsense into analysis. Even the Federal Reserve itself has admitted that, in fact, there is no right or wrong difference between good and bad, but sometimes some media or politicians. He's going to grab a piece of the puzzle and make a statement, and I hope you've seen today's video, and you've heard today's analysis. And you've seen their language skills at a glance. We're talking about the Triffin problem, also known as the Triffin paradox. Triffin, he's a very famous economist. Back in the 1960s, he argued that countries issuing international currencies would inevitably run trade deficits. When you think back to the days of the gold standard, it could be argued that the US trade deficit was foretold for such a long time. When many people talk about trade deficits, they feel as if it is a very bad phenomenon for the economy, because people may think that you trade deficits by other people's goods. If someone else makes all the money, it's a little bit like losing to another country. Is the trade deficit really so bad, so terrible? Most scholars don't agree that trade deficits are bad for the economy, but you certainly can't say they're good. If I had to sum it up in one word, I'd probably come up with a phrase that most economists love to use. That's seriously annoying too. One answer is it doesn't have to be. It depends. After analyzing so much today, I believe you should also have a feeling that trade deficit is a manifestation, a symptom. Whether it is good or bad for a country's economy depends on the reason behind the symptom. It's like saying that someone's heart is beating really fast. Does that make them unhealthy? It depends. If he has just run a kilometer or looked at someone who makes his heart beat faster, that's a healthy sign. But if he's got myocarditis, an irregular heartbeat, or a racing heart, he needs to be seen. Trade deficits are similar if it's because of strong investment demand, strong consumer demand, and you see a lot of high-growth countries or countries with a lot of investment opportunities running trade deficits. Australia, for example, has run a current account deficit for decades because it has kept attracting foreign investment. His heart beats fast, and he's normal. But if countries overheat, consume too much and borrow too much, for example, before 2010, non-German countries in the Eurozone collectively ran trade deficits with Germany. And the money Germany earned from exports was invested in cheap bonds in Spain and Italy. The result was a full-blown debt crisis. At the time, Italy, Spain, and Greece were clearly overheating. So why did Germany care so much to save Greece and Italy after the Euro crisis broke out? I remember at that time, Merkel often held meetings with world leaders. At first glance, you might think Germany really has a big brother vibe, stepping in to rescue those little guys. But Germany happens to be the biggest creditor of these countries, so he's saving himself. There is also a trade deficit, which is also very bad. For example, in Sri Lanka, the country's economy is facing collapse. The government has borrowed a lot of money from abroad, its currency is under pressure to collapse, and the central bank has to keep the exchange rate artificially high. It's also running a huge trade deficit, and it's even running out of goods. So do you see, trade deficits, they can happen in very healthy countries, or they can happen in countries where the economy is in trouble, or the economists will tell you. This video is actually some small thoughts that I generated when I checked the tariff video at that time. To be honest, it may be a bit theoretical, as it actually involves a lot of deduction and logical thinking. It's not a storyteller, so for those of you who are here, thank you very much.